Thank you, and good evening, everyone. Thanks for making it here tonight. It's actually been a while since we've ran one of these seminars. I think it was just before COVID, actually. So we're meant to be running this a couple of times a year, but obviously with COVID, bringing large groups of people together wasn't really working, and so we went to update everyone via email on the budget and things like that. But that became really time-consuming, customising emails to every client. So we went away from that, and now we're just back to this, which we'll move forward with, because it's always nice to bring people together and have a couple of drinks and something to eat. So hopefully you get something out of this tonight. I'm sure you will. We're going to cover off on a few things. It's centred around the budget, but to be honest, there was, from a financial services, financial planning perspective, there's not too much in the budget. But we'll touch on a few things today. We also have a couple of other presenters. Michaela, who's going to be presenting on financial wellbeing, and Jeff Tompkins, buyer's advocate, a good friend of mine, runs a company called GCT Property. So he's going to give us an update on the local market, residential market, and how we're positioned. Southeast Queensland is positioned for the years ahead. And he'll also take us through a bit of a scenario as well with regard to investment properties. That's a disclaimer. There's a bunch of factual information in what we're about to go through, general advice, so make sure that you don't act on anything without getting professional specialist advice. This is the agenda. So I'll do a bit of a business update for JFA, then we'll move on to an economic update. That'll just be very high level, mainly on our domestic economy, but we will touch on the US as well, given that's an important economy as well. Investment market update, again, very high level, and then we'll focus on the budget. Then we'll have a little bit of a break, toilet break, and then Michaela will take us through this question: can money really buy happiness? And then we'll close off with Jeff with a property update. So let's get straight into it. I've been in the industry since 2002, and ever since the first day, there's just been change after change after change, regulation, changes to law, and it's just been the way that it's been as far as I can remember. So we're very used to that. The biggest changes that have come through in the last couple of years is education and the requirements to come into the industry. So now you need a tertiary qualification, which is normally a degree, and it has to be related to financial planning. So what that's meant is, and that's also applied to existing advisors. So that's been a really big change, I think a positive one, but we have lost a lot of experience, because there was older advisors that have been in the industry for a long time that hadn't done the necessary study, and they've just kind of pulled the pin on everything and kind of left the industry, and that's happened quite a bit over the years. So now we've gone from about 25,000 advisors down to around 12 or 13,000. So it's a massive fall. What's been good is the client to advisor ratios. We're all very busy. There's a lot of clients around, I guess double the amount of clients. So we've been going through some pretty good growth over the years, over the last year really. And for a minute there I was thinking it was because of the good work that we're doing, but every advisor I talk to is really busy, and it's just because there's so many clients around. So what else is there? That's probably the main thing. What we do at JFA, which a lot of you already know, we're quite holistic in what we do. So we look at everything from cash flow budgeting through to investment planning, retirement planning, superannuation, personal insurance. So we like to have a really good understanding of our clients' entire circumstances. But if there is a need for a specialist like a tax advisor, legal advisor, or a debt advisor, mortgage broker, we often just refer them to the right people to implement those specialist areas. We spend quite a bit of time on the initial process in terms of getting to know our clients, getting an understanding of what's important to them, what their goals and objectives are. You know, we probably have 2 to 3 meetings, lots of emails and phone calls before we even get to the point of starting to write a financial plan. So that process is a little bit drawn out, but it really helps for that next stage where it's all about strategy development, analysis, research, and coming up with a plan that is linked directly back to the client's needs, which I think is really important in the work that we do. So that's us in a nutshell. Challenges, I think there's, for us as a business, I think the key challenge is going to be capacity. I think because we spend a lot of time with clients, each client's very different and we tailor and customise, and it's turned into a bit of this bespoke service, and it's very time consuming. So I'm thinking now that the number that I had in my head in terms of the clients that I can service has dropped dramatically. And so I think there's going to be challenges around capacity in the next year or two, which is okay because Michaela, who's just left the room, is starting her professional year from July. She's undertaken tertiary studies to become a financial planner. So she'll be able to provide advice and give advice in the next 12 to 18 months. So that will be good from that perspective. Other challenges? Oh, just the normal challenges around business efficiencies and processes, which we're always trying to work on. The latest thing that we've changed is our servicing packages. So we've just boiled it down to three packages. So we've got a light service, a light plus service, and a comprehensive service. So the light service is basically a comprehensive strategic annual review each year. So that's the opportunity to sit down, go through what's changed, review your goals and objectives, and make sure we make any changes to keep you on track. Aside from having access to our admin and queries along the way throughout the year, and of course the seminar. So that's our base level of service. The Light Plus service is the light service plus a mid-year check-in, which is where we do an internal review of your file, and then we get in touch with you, normally via phone, to go through that with you, and also take that opportunity to get an understanding of what's changed in your life, and if we need to make adjustments to the strategies, we can do that at that point as well. And then finally, comprehensive, that's essentially the light service times 2. So we're conducting that annual review meeting twice a year. So that's the service packages that we've been working with for a few months now, and you'll probably hear more about that in the coming months and years. Price-wise, all have a different price point, and it also comes down to, if you've got one or two strategies versus a full financial plan, which might be 4 or 5 strategies, that has an impact on price as well. Economic update. So our economy, Australian domestic economy, is in a pretty good place. We've had an excellent few years, but things have dropped off over the last couple of months, partly because of interest rates, but that little commodities boom that we've had over the last few years has really put us in a great position, and that's evident with the budget as well, with that surplus that's come through from Chalmers. But I thought I'd just put this slide up and I'll explain it to you, so don't worry. This is showing the change in commodity prices. So that blue shaded area, so any area above that line where the 0 is, anytime it's above that line, that represents a change or an increase to the price of commodities compared to the last 12 months. So if you look at that last peak up at 60, so at that point there in 2021, that's suggesting that the price of commodities was 60% higher than 12 months ago. And so that's huge. And that kind of price increase has been there for the last few years. And you can see there right at the end, it's starting to drop off. So that's really been the propeller for our economy over the last couple of years. And that's generated a lot of work, a lot of income. It's pushed up inflation, it's pushed up interest rates, but that's starting to come to a little bit of an end now, or it's changed dramatically from a few years ago. This is one of the impacts. We were just talking about this, Rob, the labour market. This graph is showing the last 10 years. So you can see there, before that spike because of COVID, the unemployment rate kind of sat between 5% and 6.5%. So 6.5% unemployed people in unemployed percentage would typically mean not that great for the economy. If it falls down to 5%, well, that's pretty good. That means things are going quite well. We'll ignore that spike, that's just COVID, but look at that unemployment rate now. That's right down to 3.5%, which means that every man and his dog is just working. Some have 2 jobs, and that's had a flow-on effect as well. I'll just mention as well, and I think Jeff might touch on this later, that boom in commodities required a lot of demand for labour, which has been met from immigration, which has been a good thing for our economy, but on the flip side of that, it's caused a bit of a rental crisis, which we all hear and know about. Flowing on from that labour market, the unemployment rate, this graph is also showing the last 10 years. It's showing wage, the wage index, so basically pay rises. So as you can see, with like the first kind of, 6 or so years, there's been pretty low wage growth, and that's been the case for a long time. But again, coming back to this good 3 years that we've had, that's really pushed up wages over the last couple of years. And I think Chalmers mentioned last night or during the week that we're expecting that wage growth to kind of get to 4.5%. And so you think about that unemployment rate and you think about the increase in wages, they're the two things that are kind of really driving inflation. Apart from all the profits that the companies have made, that's putting that's creating a lot of inflationary pressure. And this is the issue that we have. So this is the inflation graph. So again, this is 4 years, sorry. Where it's quite low, 0 to 2% inflation, that's actually below the target. The RBA tries to target between 2 and 3%. It's low there because of COVID, I believe. So, but as the world flushed economies with money, interest rates fell through the floor. It gave people confidence and more money to spend, which they did, and are still doing to a certain degree. And it's pushed inflation right from kind of almost zero up to 8.5% for the last December quarter. I don't know about you, but during that December-January period, I felt like everyone was just going everywhere, caravanning and holidaying, and not necessarily overseas, but some people were doing that as well. But I felt like there was just activity all around. There are a lot of people going places and doing things. And looking back on that quarter, the contribution from travel and accommodation really drove inflation during that quarter. So maybe I felt that way because I didn't go anywhere, but I had family up from Sydney, so we didn't really do or go away anywhere. But as you can see, that inflation has dropped off a little bit, so it's now at around 6.5%. And the RBA, of course, wants to get it below to 2 to 3. And I think the expectation is the 24-25 financial year we should get there. So I think the RBA might tread a little bit more carefully now, and I think that might be evidenced by last month where they had a pause, and then this month they increased. So they might just tread a bit more carefully over the next few months, possibly. So I think that's starting to things are starting to happen now, which is good and bad. So I thought I'd just throw this in. This is the interest rate. I've just never seen an interest rate graph like this. It's just crazy. 2019, what were we up there? 1.5-ish% RBA cash rate. Fell to 0.1% during COVID. And then look at that. It's just like a staircase. It's just straight up 3.75% in the space of 10 months or whatever it is. So pretty aggressive tightening. The biggest risk to our economy now, and I'm getting this from one of the fund managers that we use, their feeling is that the rollover from fixed mortgage rates to variable mortgage rates, people going from 2 or 3% up to potentially 6%. And we had a look at some data with the big banks, and there are big chunks of their loan books that will kind of mature over the 6 months leading up to December 23. So again, probably another reason for the RBA to tread carefully, but still low unemployment and wage growth are pretty big concerns on the other side of the coin. Any questions on the domestic stuff? Otherwise I'll move on to the US just very briefly. The US only started tightening a couple of months before us. There's a bit of debate there that they should have started way earlier than that. But anyway, I think we've gone up 3.5 or 3.75. They've done 5% over the same sort of period. Their economy is a little bit more advanced in terms of where that tightening is, what that's up to in terms of where they are in that tightening process. So we were listening to a presentation from an economist that suggested that there are three things. These three things, once they're ticked off, the US will go into recession. The first two have already been ticked off, so tighter monetary policy, especially to do with interest rates. That's flowed on to corporate stress. I won't go too much, actually I won't even go into the regional banks in the US that you've probably heard about, but that's an element there. Companies, or there is corporate stress around, it's much harder to gain access to credit in the US right now. So for big corporates that want to grow and generate profits, they need funds to do that, and getting that credit has become a lot harder. And then finally, consumer demand. So with us, because we had that commodities boom, so we're a resources-led economy. So that's really important to us. For the US, they're almost like a consumer-led economy. So basically, if everyone's happy and they're cashed up and they're confident, they go out and spend, and that really drives the economy. But there are starting to be some cracks in their labour stats. Job losses have occurred over the last couple of months, like significant job losses. But in saying that, last Friday, I think there was a significant increase in jobs. So still a bit volatile. That's why we put a question mark there. But the same commentator that I was listening to the other day presented this scoreboard. And before I go into this, to wrap up this section, one of the questions that were asked, and this is all independent research as well, so he just asked straight out, do you think the US is going into a recession? And he said, absolutely. So don't know the timing on that, but according to this signalling scorecard, I'll just run through this. So these are drivers and signals that highlight whether recession is going to occur. So this is for the US, not us. The first three columns, 1990, 2001, 2007. If it's a red yes, that's bad news. If it's a blue no, that's kind of good news, or things are okay. So all of those first three columns, they all eventuated. Tech boom, GFC, etc. 2012, there was an expectation of recession. And 2016 was an expectation as well. But this is what this signalling produced, and there actually was no recession during those periods. 2023 looks like that at the moment. So I'll leave that with you to interpret that any way you like. With our economy, it's really hard to say. I mean, I don't know the answer to whether we will go into a recession or not, but this is what I've researched and looked at over the last few months. As far as the US, that's a lot more convincing than our economy, but we'll see how that plays out. Investment market update. I won't stay too long on this either. The last 12 months have been pretty challenging in markets, but that comes down to where your money was invested. Ironically, if you were in safe, defensive, fixed interest and bonds, you would have had a really hard time, because those assets have an inverse relationship with interest rates. So if interest rates go up, bond prices fall, and that's exactly what's occurred. However, share markets, the international share market has done relatively well over the last 12 months, up around 10-11%. Our Australian share market is just keeping its head above water. It's kind of like 1 or 2%. But the outlook is looking okay, even given the economic concerns with what we're dealing with at the moment. Active versus passive, I'll come back to that shortly. Those next 2 points, long duration bonds and fixed interest, as well as emerging markets, they're two areas that we're focused on with client portfolios. So you may have already seen allocations to these areas tactically, so over and above what might already be in there. And there's reason for that, which I'll go through. Active versus passive first though. So active and passive management in investment fundamentals is a methodology of investing. So active is where you pay a fund manager to invest your money and make decisions on what companies they invest in. So an Australian active manager will look at the top 300 shares in Australia and hand select, maybe 20 or 30 stocks that they believe will outperform. And so that's their active process. Whereas a passive manager, they look at those top 300 companies and they just buy the entire index. So whatever the market returns, the passive manager that's the return that will be produced. So the job of the active manager is to hand select those companies and beat the passive manager to a certain degree. And I thought I'd just put this up because, I mean, we have both in our portfolios, active and passive, they're both important. But in times of uncertainty and volatility, we lean more on active managers to avoid those stocks that you don't want to be in that are all across the index, if you like. So I thought I'd just put some performance figures here. So Australian shares, passive versus active. So the active have outdone passive, not by a huge amount, but they're kind of in front. Most of the volatility has been in the last year, so I thought I'd throw that return up as well for active versus passive. The active managers that I've got there that represent those returns are two key managers that we use in our client portfolios. Okay, moving on. Government bonds and fixed interest. As I was just saying before, with that relationship with interest rates, that black line is the performance of long-dated fixed interest and government bonds. So it started at 10,000 3 years ago, now at 9,000. So they've dropped 10%. So again, this is your defensive part of your portfolio. That's the asset that we've got a tactical tilt towards at the moment in client portfolios. Now that the interest rates have almost done their job, that asset value is now reduced. So we feel like that's an attractive area to be investing. The red line, that's a combination of managers that we've actually been using in client portfolios over the last 3 years. We took the view that interest rates will eventually go up. So 3 years ago, we did give up some good returns from that black line, which were around. But for that part of the portfolio, that's the part of the portfolio we want to be actually defensive and hold up in bad times. And so that's actually done its job. It hasn't shot the lights out. It's almost stayed level, but we haven't had a fall in asset values for a lot of our client portfolios for that reason. And just lastly, emerging markets. That's an area that we're been allocating to for the last 12 months. And we have experienced a bit of volatility with that, but it's been actually up the last few months. But it's more of a long-term allocation anyway, emerging markets. But this graph is showing back to 88, so that's a long time, 30 odd years, 3 decades. So just focus on the, so you've got emerging markets. Emerging markets, if you don't know what emerging markets are, they're places like China, Taiwan, India, Russia, not that you'd be investing in Russia right now, Brazil, Chile, a lot of Indonesia and small Asian countries. So they're emerging markets versus developed markets, which are Australia, America, etc., Europe, UK. But focus on that purple line, because that purple line is the emerging markets versus developed markets. And so when that purple line is high, that means emerging markets are outperforming developed markets. But when emerging markets are low, that means developed markets are outperforming. And we look at that last decade, and it actually says they're a tough decade for EM. Emerging markets are looking really attractive now from a valuation point of view. And just further to that, emerging markets actually started increasing interest rates about 12 months before we did, and the US. And they're now at the stage where they're about to start cutting rates. So that's a really good thing for those markets. And again, it's an opportune time that we believe is to start having an allocation, a bigger allocation in client portfolios. So I'll leave that there. Any questions? Nope. Okay, federal budget. Did anyone watch it? No? Because that's why you're here. I watched a little bit of it, but then my email gets flooded with updates from various institutions, so I've just been kind of reviewing stuff all day today. But there's definitely a focus on cost of living, and yes, it is more focused on households, specifically low-income earners and welfare recipients. And as I said before, financial services or financial planning in particular didn't get too much of a mention, which is kind of okay. Definitely no cash splashes or tax cuts, which would be inflationary, of course. So there's none of that kind of anywhere. Even some of the relief stuff, where it's $500 or $600 here or there, it comes off a bill or something like that. You don't actually get money. But let's have a look at this. Were we going to have a break now? Where's Michaela? No, after mine. Yes. Okay. All right. Key announcement. So we're going to go through cost of living, families with children, social security, and also superannuation. Which again, there wasn't too much there, but let's go through these areas. So taxation, some concessions to small business. There was no mention of the stage 3 tax cuts, which are meant to come in the year after next financial year, so they're all still intact. Just on that, there was no mention of changes to capital gains tax discounts at all. There was no mention of transfer balance caps as far as account-based pensions and income streams go. There was no mention of continuing the 50% reduction to pension minimum income rates. So since COVID, any retiree who had an account-based pension was able to drop the minimum they take out of their pension from whatever it is, 5% if you're over 65 to 2.5% or whatever the rate is for yourself. And that allowed retirees to kind of preserve their capital. So that will go back to normal from next financial year, so from July. So if you're a retiree receiving an account-based pension and you're drawing the minimum, that minimum is going to go up in line with the minimum pension payments. There's no continuation of the lower to middle income tax offset. So if you're earning around 80, 90, well, I think it's like 60 to 90,000 as far as income is concerned. Last year you got a $1,500 tax offset. That will stop at last year and won't continue this year. So, you may have got a nice little refund last year. It might be a little bit light on this year because there was no mention of that being continued in the current budget. Social security, superannuation, payday super. That's probably more for employers. $3 million super cap, additional tax for high super balances, and then energy relief. A lot of energy incentives in this budget as well, which we'll talk through. So firstly, cost of living. There's a $500 payment for eligible households to deal with the rising cost of energy or electricity specifically. So again, that's not a cash handout. That's a credit on your bill. It's different for each state. Queensland is definitely $500. So if you're a pensioner, seniors health card owner, in receipt of a care allowance, family tax benefits, you'll get that $500 deduction or credit on your bill. They're also doing low interest loans. So there's 110,000 low interest loans that will become available to households to purchase solar, battery technology, energy efficient heaters and things like that for households. So not too sure about the eligibility for that. They didn't really mention too much in that. 110,000 loans. I don't know how many homes there are in Australia, but that doesn't seem like a lot. So maybe it is targeted at lower income families. That's yet to be confirmed. All of this is yet to be confirmed. These are all just proposals. So small business, same thing as the 500, but for businesses that will come through as a credit on their energy bills. So moving on, cost of living measures, pharmaceutical costs. So if you receive or you need ongoing prescriptions, there's a list of around 320 medicines, probably a little bit more. So if you require a prescription for for at least 2 months, the doctor can write you the prescription for the whole 2 months as opposed to just 1 month, which I think is normal. They can now write it for 2 months, and when you go to pay for that, you just pay for 1 month and you get 2 months worth of prescriptions. So there's a bit of a saving there for those that require ongoing medication. And then bulk billing services. This is all about taking pressure off hospitals. So the government has is considering incentives provided to GPs to provide bulk billing to, again, specific sectors of the market. We're talking children under 16, concession card holders and age pension recipients. So again, very targeted there, low inflationary, which is the theme of the budget. This one here, again, energy incentive for businesses that are going to spend money, and this is for next financial year. Yes, next financial year, from 1 July, that, you know, convert their electric heating to cooling systems, upgrade to more efficient fridges and induction cooktops. So how this works is a 20% upfront deduction. So if a business spends, I don't know, 50,000 on solar panels and charging stations for their vehicles, they would get that $50,000 deduction, but with the 20% uplift, that 50,000 goes to 60,000, which becomes a tax deduction. So again, an incentive to consider energy efficiency in the workplace or for small businesses. Taxation, thresholds to increase to 20,000. So right now there is an instant asset write-off for this financial year of 150,000, which will come to an end. But the proposal here is to extend, but at a reduced rate of 20,000. So businesses can purchase assets for the business and write them off in the next financial year. If it goes over 20,000, the amount above 20,000 will be dealt with in the normal way, using the relevant depreciation method. Superannuation. Okay, payday super, they've called it. So this is to do with compulsory super guarantee contributions. So right now, under current law, as an employee, you get paid super guarantee, and the employer has a responsibility or obligation to pay that super every 3 months, or every quarter as the minimum. So they're proposing, and this only commences July 26, that contribution goes into your super fund in line with your salary frequency. So if you're paid weekly, fortnightly, monthly, they don't wait 3 months. They do it then and there. So that applies to super guarantee. So the driver behind that is to reduce employers getting hit by the penalty taxes or the penalties that apply when you don't pay by that quarter. So they get in trouble for that, and they get fines, and so it's to reduce that. It also helps the employee because you've got money going to your super fund more frequently, which does kind of drive returns, but I haven't done the numbers, but that would produce a benefit over the long term. The ATO estimates that $3.4 billion of workers' super was unpaid in 2019, 2020. So this will help with tracking as well and make sure there's less of that happening for employees.
Has the percentage changed myself, or is it still the same with the super guarantee?
It's changing. It's going to keep changing until it gets to 12%. I think it's 0.5% a year. It's currently at 10.5. Yep. So 11 from next year, I believe. $3 million cap. You may have heard about this. It's been around for a few months now. It's been under consultation, I guess, but now this has been put forward as an actual proposal to commence from 1 July 2025. So what it is, like right now, with your superannuation savings in accumulation phase, so when you're building your money up, the tax on the earnings is 15%. And so what this proposal is, if your total superannuation balance is more than 3 million, the part that's more than over 3 million will get taxed by another 15%, so a 30% tax rate. So that's what the proposal is essentially. There's a big formula that's you need to work through to work out what the earnings are, because it's not actual earnings. It's the change in your balance from the start of the year to the end of the year. They take into account withdrawals and contributions and that sort of thing. And then if your balance has gone up, it'll get taxed the additional 15%, but that'll only apply to the part that's above 3 million. If you're a member of a couple, you get 3 million each. So I think that's strategically, you can manage that to kind of work if you're in that position where you do have that level of funds in your superannuation. So that's, again, in proposal stage. It's not indexed, so whilst that sounds like a lot of money, over time, especially with, kids finishing uni and earning 100,000 straight out of uni and going into the workforce, and if it's invested well, it can get to that quite easily, especially if you start putting contributions in. So something to look out for down the track around that indexation, but at the moment it's not indexed. So over time, that cap will capture more and more people, which is obviously intentional. Social security. All right. There's a few things here. The biggest one I think is rent assistance. So if you're in receipt of rent assistance, there's an increase of 15%. The rent assistance payments around $157 at the moment. That will actually index in September normally. It normally indexes in March and September. And then once that indexation has applied, they'll put another 15% on top of that. The next section, working age and student payments. So this is aimed at job seekers, single parents with children. And let's face it, it's $40. I don't know what that's going to do every fortnight, but it's an increase. So that will apply to, as I mentioned, job seekers, single parents, and also students that are in receipt of allowances as well. So support for single parents. So this one here, so at the moment, if you're a single parent with a dependent child, you receive the parenting payment, which is it's almost $1,000 a fortnight. But once that child gets over age 8, you must go on to the job seeker payment, and then that job seeker payment drops to like $750. So the change here is that they want to increase the child's age from 8 to 14, so the parent can stay at home for longer, not feel the pressure of having to go back to work and care for their children for longer. So they'll get that higher payment and not need to go across to job seeker until the child is 14. And finally, older Australians in receiving that job seeker payment get a higher payment if you're 60 right now. So the government acknowledges that if you're a bit older and you're looking for work, it does become harder when you're over 60. They're dropping that back to 55. And they actually receive a higher rate at that point as well. So I did some figures here. So the total uplift for a single parent with a child that has just turned 9, for example, will get an uplift of around $265 per fortnight. That's a pretty big increase compared to that base income. And then if you're, say for instance, 56, the uplift based on these changes would be around $85 a fortnight. And then the rent assistance, I reckon that'll probably go up to about $190 per fortnight. So little bits and pieces there. Apart from the parenting payment, nothing to kind of write home about, but I guess it's still an increase for those that in this environment would be really tough, I think. Just with like petrol and groceries and stuff like that. Housing, okay. Jeff will probably touch on a little bit of this, possibly, Jeff? Housing, a little bit, yeah. I won't spend too much time on this, but essentially there's a couple of schemes that are going on at the moment, have been for a little bit. First home buyer schemes where that first one with the arrows, the buyer only needs to come up with a 5% deposit. In normal circumstances, they would be hit with mortgage insurance, but the government steps in and becomes a guarantor and protects the bank, so they don't need to take out mortgage insurance. So getting into a home there at 5%.
Also made a change myself to you don't have to be Australian citizen now.
Yep.
They're opening up to permanent residence.
Oh yes.
So a lot of New
Yep.
Zealanders that come over are permanent residents. That's going to help a lot more people that struggle with a low deposit.
Yes. Okay. Yep. Yeah, I noted that as well. That change. So the family home is for single parents specifically, and they only need to come up with a 2% deposit. Same arrangement with the government. But they do have to have an independent child. So yeah, the key changes are around. So previously it needed to be an individual or a couple. Now that individual or couple, or the couple more so, can be like you and a friend or you and a sibling. It doesn't need to be a spouse or a de facto relationship. As Jeff mentioned, don't need to be a citizen, must be a permanent resident. For owner-occupiers only, which has always been the case. And it's not, technically, you can be a homeowner or have owned a home as long as it was not in the last 10 years. So that's kind of catering for those where, you know, they've gone through a financial crisis or a family breakdown and lost the home, and 10 years later they're now ready to buy again. Under the old rules, you wouldn't be able to because you've owned a home, whereas now they're acknowledging that and saying, okay, well, you can take up these schemes. So I'll leave that there. And then, there are some income limits with those schemes. So you need to have taxable incomes around 125 for a single and 200,000 for a couple. And as mentioned, the purchase is for owner-occupy. These are the caps relating to those schemes. New South Wales, capital city, probably scraping a 1-bedroom, I reckon, two-bedroom apartment. So they're the caps there. Where to now? Michaela's presentation. Where to now? If you have any questions, we didn't cover a few things in that presentation. I noted a couple of things here. There's proposed penalties, changes to penalties in relation to non-arm's length expenses with regard to SMSF. So happy to talk through that if you have any questions. There's a proposal to invest $2 billion into hydrogen, which is a green kind of efficient technology that is still kind of early days, but that can drive investment decisions potentially. There's amnesty for small businesses if they've still got outstanding tax bills from a couple of years back. The ATO said if you're going to lodge your tax return this year, we won't fine you. For developers, there's a concept called build to rent. I won't even go into that. And aged care workers, there's been some uplift in their wages as well, which is great because if anyone needs an increase, it's those people in those positions. So that kind of rounds out the update from myself and also the federal budget update. Is there any questions on your mind? No? All good? Okay, well, help yourself to another drink, some nibbles, toilet. We'll have a little 2-minute break and then Michaela will kick us off for the next section.
Thank you so much for coming, everyone. I appreciate most of us a bit of a longer journey than we had planned, so we really appreciate you being here with us tonight. And thank you, Marcel, for that really great update on how the investment market's doing and the budget. We've got a slight change of pace. We're going to be talking about the phrase, money can't buy happiness, and whether or not that is actually true. In the psychology field, there's actually a really big debate about it because there is evidence to say it does and it doesn't. So after reviewing some research, I do have some good news and some not so good news for you on that. So the good news is money can't literally buy happiness. It's not a product that we can buy. We can use money to buy things that bring us joy and add that intrinsic value to our lives, but not physically buy it. So that is some good news. However, there is a bit of a correlation between your perceived wellness and your financial position. This is seen kind of in all areas of the world as well, not just isolated to one particular country. Also with these kinds of data, it's really important to be mindful that everyone's perception of what their financial situation and what their wellness is going to be very subjective. Not everyone's going to think the same way about their financial position as someone else. And these things can also be influenced by cultural values or personal values, and also the mindset that you have towards your finances. So we'll be looking today at the ANZ Financial Wellbeing Survey. This was conducted about mid-2021. So we kind of started to capture when the price of goods and services was starting to increase after COVID. So this survey asked about 5,000 people across Australia and New Zealand to score them on these 4 categories. So meeting everyday commitments, feeling comfortable, financial resilience, and feeling secure for the future. With this survey, they had an average financial wellbeing score for all participants was 64 out of 100. So it's kind of a little bit over average. And then these participants were then allocated to the following 4 groups. We've got the no worries group, doing okay, getting by, and struggling. So we're going to actually break down each of these to see where people kind of scored themselves. So we'll start with the no worries group. This accounted for about 30% of the entire participants. So their average financial wellbeing score was about 90 out of 100, which is a lot higher than the average that we saw over everyone who undertook the survey. These people were much more positive about their financial future. They felt that they were secure for the rest of their lives. They also had a higher level of income than the majority of participants, over $100,000 per year, and they also had a lot more in savings than kind of the general population. They're also more likely to invest in things like their superannuation, investment properties, or the share portfolio, and they're also more likely to seek guidance from professionals such as an accountant or a financial advisor. Also, which is probably not very much of a surprise, they were more likely to be retired, so they've had a bit more of that longer investment time frame to build their assets and also pay down some of that debt. And a lot of their income is funded from the superannuation or other self-funded means. A lot of them are also living with a partner, and they didn't currently have children living with them, so kind of more empty nesters. And in terms of their physical and mental health, they report this as being excellent or very good, which is the kind of top of that scale. So yeah, this kind of makes sense. If you feel that you're more financially secure because you're meeting your needs and obligations, you're going to feel a lot more positive about it as opposed to if you weren't meeting those obligations. We're now going to move on to the Doing OK group, which is almost half of the participants who fell into this group. Their average wellbeing score was around 60 out of 100, so it's just under that overall average. Whilst most people said that they could meet their obligations, such as their bills and their credit card commitments, without difficulty, there was about a third of those participants that said that they struggled from time to time to make that happen. This group was also more likely to budget and plan than any other group, and they also had their savings put aside automatically, also more likely to use things like bucketing with their bank accounts to kind of make sure everything was all automated. This group was also more likely to own their own home with a mortgage, also to use an offset account. 1/5 would either always or regularly make higher payments than they needed to for their mortgage, and they found it somewhat easy to make these payments. This group was also more likely to be employed full-time and be older families, so families with kind of teenage adult children. They generally reported that their physical health and their mental health was good, a little bit of a step down from what was seen with the group before. And they did actually experience that they were feeling very anxious about their financial future than the group before. And this life stage is more transition to retirement, or they're starting to look at that, making strategies to make their retirement plans a reality. So they might just feel a little bit more anxiety because they're only starting that journey now. And we're also seeing the decline of their income rate. So they're having a lower rate of income than the No Worries group, but they're also having a higher level of debt. So we can kind of see why the anxiety might be there. Now we'll go to the Getting By group, which was about 17% of the participants. They had an average wellbeing score of 41 out of 100, which is significantly lower than their overall average. They were less likely to hold those more defensive assets like term deposits and savings accounts with bonus interests. They're also more likely to have various forms of debt such as personal loans or car loans, or use things like Afterpay and ZipPay and all those sorts of things. A lot of these people were living with a spouse or a partner and they had younger families, or there was someone who was older and they were living with their parents still. Out of all the young adults who took part in this survey, this is the category they were overrepresented in. There was a lot more of them in this category than the others. And while this group was mostly full-time employed, of the part-time workers who took part in this survey, a lot of them also fell into this group. Their main source of income was their wages or their salary, but they did also have things like government benefits or allowances to kind of help supplement that income. And here we're kind of starting to see another decline in their mental health. They're now describing it as fair or poor, as opposed to the groups before were feeling quite okay with their mental health. And a significant amount of these also felt really anxious about their financial future, and they were less likely to invest, which is likely because they may not have that revenue left over to invest. They're also less future orientated, they were less optimistic, and they didn't have that goal orientation that the other two groups that we've spoken about have had. Also recorded as being more impulsive than any other group. And yeah, we're seeing that further decline in income again, higher level of debt, And yeah, that dramatic drop of their mental health and that anxiety is also really important. We're starting to see why maybe that money can't buy happiness might not exactly be as true. And we've got our last group, which was struggling. Their average financial wellbeing score was 19 out of 100. So it's definitely the other end of the spectrum to our no worries group. Most of them described their financial situation as very bad or somewhat bad. And about 75% of these rarely had any money left over after they've paid their bills and bought groceries and things like that. Another about 75% reported they didn't have any savings. So if they had a unexpected expense, whether it be medical or they'd need to replace a car or an appliance or something like that, they wouldn't be able to cover that from the money in their bank account. This group was also less likely to be employed full time and more likely to be looking for work. And they're also less likely to be degree qualified, whereas the groups we've spoken about before, they had higher levels of that tertiary education. For this group, we're seeing the lowest household income, which was under $35,000 per year. And almost 1/4 of these reported that their income varied and wasn't quite consistent every month. In this group, it's quite a variety of different people who fell into this, but mostly we had people aged between 25 and 34. More women fell into this group than men did. People who may have experienced a financial crisis such as a divorce where it's impacted them financially felt like they felt into this group. Single parents as well, people currently living in the current rental market would have felt that as well. And also looking at some older generations who might be living with their adult children as well. And this group had the most negative report about their physical and mental health, because in this group some people may be experiencing a very serious medical condition that might prevent them from working. Also, this group was the most likely to have personal debt such as a personal loan or a car loan, payday loans, use things like Afterpay, but also borrow from their friends and family. Majority of the people somewhat agreed or strongly agreed that they felt very anxious about their financial future. So again, we're seeing that decline of income and that increase of debt, and they're feeling a lot more anxious about that current position. So overall, we are kind of seeing, which you can see in this bottom graph on the left, as income is rising or you have a high level income, your wellbeing score is a lot higher, because that makes sense. We know that if your needs and your obligations are met and you've got a surplus left over, you're usually going to feel better about the position that you're in. We've also there's a consumer debt. People who had more debt usually feel a lot more stressed because they've obviously got payments that they need to make on that, which use a lot of their cash flow, so they don't have that surplus that people who have lower levels of debt typically have. Another really important factor as well was our financial knowledge. So on the right-hand side, we've got financial knowledge score of 95. That's typically what we find in that no worries group. They are older, they've probably had some more experience, they've had that time to gain that knowledge and that experience as well. More likely to have invested as well and have different types of investments. And all of that has kind of led to this value of 80 in the end, which is in between, more closer to the no worries group than the one below. However, down the bottom, we've got financial knowledge score of 34, which these criteria fit more the struggling group as well, because they haven't had the opportunity, or they may not have had made available to them. Financial education, it might just not be something they've been able to access, and it's really impacted their overall financial wellbeing score, which is 46, so it's almost half of that kind of no worries group. Oh, sorry, one more. And I've also got today just some tips for your financial wellbeing. As you'll probably notice, none of this is financial advice. This is more about your mindset towards your finances. For example, try not to compare your goals and your position to others. Especially with things like social media, we can see everything everyone posts, and we kind of can make assumptions on what their situation is and what their goals are. And that can be really difficult if you're comparing yourself to them all the time. And it's really important to remember that your goals are completely unique to you, your position is completely unique to you. And it's important to understand that we don't understand everyone's goals all the time, and just because, well, if you're similar ages, they may not be the same. And also when people post online, they're typically seeing the more positive side of everything rather than the negative, so that can also impact our perception. Also setting SMART goals. If you set a goal that's really unattainable, you're going to be less likely to reach that. It's celebrating the small wins, making sure that they're kind of realistic and that you're able to achieve them, and you're going to feel more motivated to reach your goals if they're attainable. And in this case, sometimes it's just all about perception and mindset. And also with our financial mindset, there are so many things that can impact this, such as the way that we've been with money in the past, our experiences, also how our parents dealt with their finances. That can also have an impact on how we view our money and our finances. Also our personal values, which can change over time, and our beliefs, they have a big impact on how we handle our finances. And it's 100% okay for these beliefs and to kind of change and evolve over time as we learn more. And this will probably reflect in your finances as well. And this one, I know Marcel uses this quite a lot. Balance is really important. If you kind of go too far one way or the other, you're not going to have either that quality of life or that financial security that you want. So making sure that you understand balance is okay, balance is actually really good, and find out what kind of balance means to you in that effect. And that's kind of us done. Does anyone have any questions? Oh, wonderful. Oh, thank you, Jeff. Well, look, there actually is. Kids are great. We love kids. But yeah, no, it's usually our kids perform another one of our expenses. And kids can be very expensive. So there is a little bit of a correlation, but I'm not saying that your kids have caused your issue with your financial wellbeing score, but it is something to also consider.
It's a bit like you already got kids.
Yeah. Yeah, can't reverse that one, Mars. Anything else? Wonderful, thank you so much. And next we're going to hear from Jeff Tompkins, our really great friend at GCT Property. He's going to give us a residential property update.
Inviting us along. I've known myself for a number of years now, and we're always talking about the market, stocks, shares, property. It's a really good thing to have those conversations about what's happening in the market. So I've personally been involved in property for well over 30 years now, and had property in New Zealand, used to buy and sell and renovate and develop, and now coming to Australia, was in the building trade, always had a passion for property, and about 10 years ago I started working for some groups in property, and then I set up my own business probably about 8 years ago. So long-term relationship with property. So tonight we're going to cover a bit of what's happening in the Australian property market, then we're going to focus more on this Southeast Queensland corridor as well. I think one of the most important things to take is don't believe everything that you read in the media. A lot of it's really skewed and they just focus on one specific segment. But look at, listen to people that have been in the industry, done well, and have an overall view of the market. And looking at all the data as well is really important. So what we're seeing is a surge in the overseas immigrants coming into Australia. The government has approved 200,000 permanent residents in this calendar year, and that's going to happen over the next 5 years. And that's on top of that, we've got students coming back into Australia and expats coming back as well. So some of the forecasts between that 300,000 to 400,000 population growth just in this next 12 months alone, which is really strong, and that's going to continue. So that's going to put pressure on the property rental market and properties for sale. So we all know, as if you're a tenant and renting a property, it's just becoming more and more difficult to secure a property. So I employ everyone that's renting a property to look at ways of achieving home ownership. I think the government did a great thing with opening up the schemes to more applicants now. That will help more people that are really struggling for that deposit, because of, as we've seen with property prices growing, the amount of that 5% deposit's got larger and larger. And when you add on lenders and mortgage insurance, which can be 15, 20k on top of the deposit, it's quite often a stumbling block. So I think it's a good thing that the government's done. In terms of the property market, we've seen a pretty flat property market since the middle of last year, when we saw those strong interest rate rises, and that was really to be expected. We saw massive growth in most properties in most regions around Australia coming out of COVID. On average it was about 40% growth, which was huge over a 2-year period. Last year it was a pretty flat market. Most markets dropped back in terms of price point, which is pretty typical when you look at property cycles. They go through a boom period and then there's generally a drop in the market, 5 to 10%. It's pretty normal, and then those markets recover again. So with properties, generally it's a longer term, overall view. One big thing for the Southeast Queensland corridor we've got going for us is we're hosting the 2032 Olympics, so that's only 9 years away now. The government just announced in the budget a few billion dollars, I think it was 6.5, going towards the stadiums and the facilities for the Olympics. So that's going to have an effect on the Southeast Queensland corridor as well. It's going to bring more work into the region. It's going to create more employment, and again, more people are going to be moving in. So it's just a compounding effect. So we're in a pretty strong position in Southeast Queensland in terms of population growth. And a lot of these overseas immigrants that are coming into Australia, it's actually quite difficult to get into Australia now. And so they're attracting more skilled and wealthy people into Australia, and these higher net worth people are going to be buying assets in Australia, which is going to have another effect on property prices as they're coming in, because they will need to rent or buy somewhere. So federal government's forecasting Queensland's population to grow by more than 16% in the next 9 years, which is huge, so that's a compounding effect as well. As you can see from the graph on the right hand side, Queensland's population growth, we're outperforming the rest of Australia, have done since COVID. So coming out of COVID, Queensland or Southeast Queensland had a lot of interstate migration, moving here for lifestyle and affordability. The fact that we can work remotely now for a lot of people has meant they don't have to be in the capital cities necessarily for their employer. So that's changed the way people can work and where they need to be for work. And as you can see from the graph there, Queensland's got a 2% population growth, very strong, outperforming the rest of Australia. So again, just going forward, if you're thinking about what's going to happen over the next few years, this data, these statistics are going to point you in the right direction. Latest data brought to you by CoreLogic, RP Data. So what we're seeing is, look at the graph over the last 12 months, a lot of property markets dropped back, that 5 to 10%, which was pretty standard for after a big boom period. But what we're seeing now over the last quarter, and especially over the last month, that data is actually turning around now. We're starting to see that in results. So anyone thinking, you listen to the media talking about property prices dropping 10, 20, 30%, you look at the facts and the figures, and Sydney, Melbourne, Brisbane, Adelaide, Perth, all up over the last 30 days. So you see that decline dropping from annual to quarter, and then actually we've turned the corner. So it's still a pretty flat property market, but the fact that decline actually slowed right down over the last quarter, and now it's really turned a corner. So I think there's a number of reasons for that. The main thing was those interest rate rises. I see a lot of home buyers and investors held off the market because they were worried about the interest rate rises and concerned about what that was going to do to property prices. A lot of people sat on the fence. I speak to a lot of buyers as a buyer's advocate myself, helping clients invest and buy their own homes in this corridor. A lot of people were holding off to see if property prices were going to drop back significantly, but what we're seeing now is no, actually hasn't really been the case. There's still not enough property for the demand that we've got going on here, and property prices are really related to supply and demand. So those interest rate rises are now starting to plateau, and that's going to give home buyers and investors confidence. And if you listen to the four big banks, the end of last year with those rate rises, they were all forecasting the Australian property market to drop between 5 and 10% this calendar year, 2023. They've just revised all their estimates, and they're all forecasting property prices to be up by the end of this financial calendar year by 5 to 10%. So they've really turned the corner. They really got it wrong. So again, just strength of the market, and even the banks are forecasting, pretty strong property price growth. So vacancy rates, so this is related to property and rental property. So we consider a 3% vacancy rate a pretty tight market. So what that means is for every 100 properties listed for rent, there's about 3 that are vacant, and that's pretty normal because people are moving in and out of these rental properties. So if you hear a vacancy rate of 3%, that's considered a pretty tight rental market. What we're seeing now is houses at 1.2 across Australia, so extremely low vacancy rate. So again, if you're thinking about investment property or you've got property and you're concerned, are you going to find tenants? Most regions now, the vacancy rate is extremely low, Southeast Queensland especially. So that's the vacancy rate brought to you by Real Estate Investor for the Gold Coast. So again, vacancy rate under 1%, which is historically low. So, very tight rental market. So again, if we're seeing horror stories now, people having to live in caravans and live with families and park benches, very sad, but it's just the fact of the reality, unfortunately. We're not building enough new properties to satisfy this population growth. So again, if you're renting, I would employ everyone to work towards that savings goal of getting onto the property ladder, because I can't see the vacancy rate and rents changing anytime soon. I can only see it getting tougher, and rents going up is related to that market. And what's happening now with the construction, because of these interest rate rises, a lot of projects were put on hold. So the number of new constructions being approved in the southeast Queensland corridor is actually less than it was coming out of COVID. So less properties being built, new construction, and more people coming into the region. That's the vacancy rate for Brisbane, very similar to the Gold Coast. Again, 1% is extremely, extremely tight. This is just a case study of for anyone new to property investment, thought, how does it all work? What's it going to cost me? This is just some generic figures on a brand new freestanding sort of house there. So I've just used some very generic numbers based on average figures, just to give you a bit of an indication of how an investment property would work. So property worth about $700,000 with a rental income of about $600 a week. So looking at the left-hand side there, we've got a deposit around about $100,000, so we'd have a loan on the property of about $600,000. So on the right-hand side of the screen is the income and expenses. So we have the loan repayments that would be interest only. Generally speaking, with investment loans, the interest is a tax deduction, the principal isn't. So if you've got debt on your own home, generally you're better off to put it into your own home. So mortgage payments per year about $33,000. And then the annual property expenses of $8,500. So that's rates, insurance, property management costs, etc. So we've got total expenses of $41,500. And on the right hand side, you've got the income from the property. So you've got the rent at $600 a week, about $30,000 per year, and the tax savings. So it's a brand new property, so you get very good depreciation. So this is based on some average salary figures. I do a very detailed property investment analysis cash flow that really breaks it down, but this is just a very generic figures. So the tax savings on that property on an average income would be somewhere around about $9,000 per year. So that means we've got a total expenses of $41,500, income about $39,000. So that's costing us, about $2,500 per year, or owning that property for about $50 per week. So pretty affordable. Look at it as compulsory savings. So that would be what's considered as negative gearing. So a lot of people get freaked out from when they hear the term negative gearing. When I was buying property, most properties were negatively geared initially, so I had to put some money into it, but that's okay as long as you're investing in an area that got that long-term capital growth. And just remember, those figures are based on today's results. Over time, rents will generally increase, so that cash flow shortfall will improve. But just looking at the figures without the rental increase taken into effect, and looking at the property performing at a capital growth of about 6% per year. So that's the average capital growth for a standard home Australia over the last sort of 50 years, about 6%. Some years it'll perform much, much better than that. Other years it'll be under that, but the average is around about 6%. So if we bought that property for $700,000 today, and it grew by 6%, compounding per year, after about 10 years, the equity gain in that property would be about $550,000, which is huge. Over 10 years, so that's like saving quite significantly per week, and per year that's going to perform very well. So that's based on a 6% capital growth. That property is growing in value by about $55,000 per year, so about $1,000 per week. So if you imagine trying to save $1,000 per week, it's pretty difficult for most people on the average incomes, and that property's going to tick away, and based on 6%, that would give you value in 10 years' time of about 1.2, and that equity upside of about 550 that you could use to invest in super, shares, or fund your retirement. So it's a great asset to have for long-term growth. So that's just a very generic scenario of how an investment property would work. When we work with clients, we will look at specific incomes and cash flows, interest rates, rent, expense, etc. But that's just a very broad overview of how an investment property would work. So have we got any questions about the numbers and the investment property, how it would work? No? All good? Okay, so that pretty much wraps up my part of the presentation. I think there is a lot of positives going forward if you're looking at the property market. If you own real estate, I think we're in a pretty strong position in the southeast, Queensland corridor. Even again, the banks are forecasting very good growth going forward. If you're thinking about property investment, it's all really about the numbers. So the way you buy your own home is based on emotion, what suits your lifestyle, your family, and your affordability. If you're looking at the investment property, it should really be focused around the stats and the numbers and the figures. So very important. So as I mentioned, I'm a property buyer's agent. So if anyone would like a discussion, I have a chat of how it all works and specific properties. I focus a lot on positive cash flow properties now, where we're getting much stronger income than that case there. So there's some great opportunities around. But any questions about the property market? No?
Where could you find, what suburbs would you be looking at for a brand new home for
700,000 in the southeast Queensland corridor. If you're talking about the Gold Coast, where the northern Gold Coast corridor, there's, as you know, on the Gold Coast, very limited land now, and we've seen some very good, strong capital growth, and the forecasts are very strong going forward. So for the Gold Coast, brand new property, we're starting around about that high 7 figure, and we've got some high cash flow properties on the Gold Coast around the 870 mark. They're returning about $1,100 per week, so some strong rental income. So we can find new properties, but they'd be more at that Ipswich-Logan corridor, between that 500 to 700k mark. But again, focus on the numbers, focus on where the population is growing, where the infrastructure is going in. If you're looking to buy ahead of the curve, where the new schools, let's look at where McDonald's and Bunnings, all those big corporate companies are very smart. They're buying land ahead of the developments, and they're doing very well long term. So wherever you're seeing new schools going in, universities, transport corridors, that's a real positive, and we've seen with the Gold Coast. This northern corridor is massive, we've got an investment property here at Coomera, and the infrastructure around this area has changed dramatically, and it's created a lot of capital growth, which is fantastic for home buyers and investors. So.
And just lastly, we had a question come in regarding capital gains tax discounts. There was no talk about that in the budget, there's been talk about it being removed or changed or reduced. If that discount is removed, what would be the flow-on effect to property investment, do you think?
Yeah, so it's a good question. And so every few years, the governments will talk about, so as an investment property, you're treated like a business owner. So there's some great tax deductions you can have from being owning an investment property. And in terms of capital gains tax, generally there's a discount if you own the property longer than 12 months. So if you own the property more than 12 months, you pay 50% tax on the capital growth. Long term, so they've proposed that change. Marcel, as you said, they've proposed a lot of changes in the past about negative gearing, and when it's actually got to it, it actually hasn't come into play. So a lot of these are just proposed changes.
Yeah.
So
it's not even proposed, it's just discussed.
Yeah. So I think when you look at the Queensland government last year, if anyone remembers, they were going to bring in a land tax for property investors. We've got a rental crisis, and that proposed tax was going to come in, and that scared a lot of investors, which made the rental crisis even worse. So it was a bit of a crazy situation. So they talked about it, but they didn't really analyse it. So capital gains of my own properties, I've valued capital gains as like making a profit. Like when you earn an income, you have to pay tax. When you run a business and make a profit, you have to pay a tax. Same with the capital gains tax. It's part of doing business. Whether it happens or not, none of us know. But looking at the long-term growth.
Yep.
There was another question as well, Marcel.
That was to do with Labor policies. Will that be driving any kind of investment strategies or decisions?
Yeah. So if the way, pros and cons to look at it, if those proposed, like the negative gearing changes ever came into play, or the capital gains changes, it is going to put some investors off making that decision. But for those that have made a decision and got property or bought property, that's a good thing, because there's going to be less supply, and that's going to put even more pressure on the rental market, So the government really has to stimulate. We're not building enough new homes, and we're not creating enough new properties for this immigration coming into Australia, and specifically southeast Queensland. So I think they've really got to sit back and look at it and work out how they're going to fix this crisis. I think the government are not good at building properties. That's not their thing. So again, they encourage investors with these tax deductions and things like that to help solve part of that crisis.
Excellent, thank you.
All good?
Thank you very much.
Thanks, guys.
Okay, everyone. Well, we've come to the end of the night. Hopefully, you get a nice, relaxing drive home. But thank you all for coming. Thank you for making it tonight. I will be around for a little bit anyway. I'm going to have another glass of red if you'd like to hang around for a chat. But otherwise, thanks again for coming, and yeah, safe travels home. We'll talk to you soon as well.